When people talk about Warren Buffett's big silver play in the late 1990s, they often reduce it to a single line, "I bought a lot of silver." That's true, but it misses the real essence of what happened and what that move represents about how great investors think. To really understand the power of that decision, you have to go back to a time when silver was not fashionable, not glamorous, and certainly not on the radar of institutional money. It was a market drowning in skepticism. Prices had been languishing for years, and most analysts saw no reason to expect anything different. The narrative was simple: the world had moved beyond precious metals, the future belonged to equities and tech. And yet, quietly, almost invisibly, Buffett began accumulating silver, not in a single stroke of bravado, a methodical process that reflected both patience and precision. Between 1997 and 1998, Berkshire Hathaway purchased roughly under 11 million ounces, more than 3,500 tons of the metal. The buying was so discreet that the market didn't even realize who was behind it until the position was fully established. That kind of stealth is rare in modern finance. Most investors can't resist telegraphing their moves. Buffett's team, however, executed with the discipline of a military operation. The goal wasn't to make headlines. It was to build a position without disturbing the price, to quietly load the spring before anyone else noticed the tension. At the time, silver was trading near $4 an ounce. It had been stuck there for years. The consensus was that it would stay there indefinitely. But Buffett saw something different. He saw that inventories were tightening, that supply from mines was not keeping pace with industrial use, and that the market's apathy was setting up an asymmetric opportunity. He wasn't predicting an explosive rally, he was identifying a mispricing of risk. When everyone believes an asset will never move again, its downside is often limited and its upside potential becomes a matter of patience. That's what contrarian investing truly is. Not just doing the opposite of the crowd for the sake of it, but recognizing when the crowd has stopped thinking. Most people in markets are not really analyzing, they're imitating. They look for confirmation, not contradiction. Buffett's silver bet was an exercise in independent thought. It wasn't about silver per se, it was about the discipline of ignoring noise and anchoring decisions in evidence and logic. Think about how uncomfortable that must have been. Imagine being known as the greatest stock picker alive, someone who spent decades dismissing commodities, and then quietly buying one of the least loved metals on earth. That's not impulsive behavior, that's intellectual flexibility. The ability to change your mind when the facts change is a superpower in investing. Buffett didn't betray his principles, he applied them. He bought value when he found it wherever it happened to exist. And when you study that trade, you see that the real brilliance wasn't the profit, though the profit was substantial when silver later surged towards 7 nines and 8. The real brilliance was the timing and temperament. He didn't rush in or out. He entered when pessimism was total, and he exited when enthusiasm began to return. It's a simple rhythm. Buy when others won't, sell when others start to agree with you. But few can execute it because it requires emotional detachment. Buffett often says he likes to be fearful when others are greedy and greedy when others are fearful. In silver, he lived that principle to perfection. He took a commodity that had been discarded and treated it like a business opportunity, assessing its intrinsic worth, its scarcity, and the psychology surrounding it. He didn't need silver to change the world, he just needed the world to wake up to its value. So when we talk about that big silver bet, what we're really talking about is the art of conviction. It's the courage to trust your reasoning when the market's narrative is against you, and the patience to let that reasoning unfold over time. It's about playing the long game in a world obsessed with immediacy. That, more than the ounces he bought or the dollars he made, is what makes the silver move one of the purest examples of contrarian brilliance in modern investing. Silver has always occupied a strange place in the world of investing, caught somewhere between the glitter of gold and the utility of copper. It's a metal with an identity crisis, and that's precisely what makes it fascinating. When Warren Buffett made his move into silver, it wasn't just because it was cheap. It was because he understood that silver operates on two levels of value at once. On one hand, it has a centuries-long legacy as money, a store of value and hedge against currency debasement. On the other, it's a crucial industrial input woven into the machinery of modern civilization: solar panels, semiconductors, medical devices, and electronics. That duality is what separates silver from most other commodities, and it's also what gives it resilience in a world that constantly swings between inflation and innovation. If you step back and think about it, gold is largely a psychological asset. It has almost no industrial use. Its value comes from collective belief, the idea that it's rare, durable, and eternal. Silver, however, has substance behind its symbolism. It doesn't just sit in vaults or jewelry boxes. It moves through supply chains and factories. It conducts electricity. It reflects light. It sterilizes bacteria. Every time a new solar panel is made or an electric vehicle is produced, a small portion of the global silver supply disappears into productive use. And unlike aluminum or copper, silver's supply is limited and declining. Since it's often mined as a byproduct of other metals, that combination, rising industrial demand and constrained supply, is a setup few investors truly appreciate until it's too late. Buffett understood this distinction intuitively. He's always said that he prefers assets that do something, businesses that produce cash flow, farmland that grows crops, or real estate that generates rent. Silver, while not a cash flow asset, sits closer to that productive category than gold does. It gets consumed, not just stored. That's a critical insight, because when a metal is consumed, it creates a natural floor under the market over time. Even if investors lose interest, industry keeps buying it. And when investors do return, they're competing with that industrial base, which tightens the market dramatically. In the late 1990s, when Buffett began buying silver, industrial demand was quietly accelerating. Photographic film was still a major consumer, but the real story was technological silver's unmatched conductivity and reflectivity were becoming indispensable in electronics and emerging solar technologies. Meanwhile, mine supply wasn't growing fast enough, and inventories were being drawn down year after year. Buffett saw what the data was whispering, that the world was underestimating how essential silver was becoming. He didn't need to forecast a revolution in renewable energy. He just needed to recognize that the industrial backbone of silver was strengthening while its price remained stuck in the past. That kind of insight comes from systems thinking, the ability to connect dots that others treat as separate. Most analysts look at commodities in isolation, one market at a time. But the truth is, metals are interconnected with the macroeconomy, with energy transitions, with technology adoption. Buffett's approach to silver reflected a principle that great investors like Ray Dalio often emphasize. Everything is part of a larger machine. When one gear starts turning, say, the world electrifying at scale, another gear, like silver demand, starts turning faster. The market doesn't always price that in until the feedback loop becomes obvious. This is why silver's dual nature isn't just a curiosity, it's a strategic signal. It tells you that this is an asset whose value can rise from two completely different drivers, fear and progress. When the world loses faith in paper money, silver rallies. When the world accelerates into technology and renewable energy, silver rallies again. Few assets can claim that kind of symmetry. It's both a crisis metal and a growth metal, a hedge against collapse and a bet on innovation. That's a rare combination, and Buffett, ever the pragmatist, was drawn to that asymmetry. There's also a psychological element at play. Because silver isn't as glamorous as gold, it often flies under the radar. Retail investors chase it in extremes, but institutional investors tend to ignore it. That neglect creates inefficiency, and inefficiency is opportunity. The best investments are often the ones most people dismiss because they seem too small, too volatile, or too complicated. Buffett wasn't trying to time a speculative boom. He was positioning himself in an asset whose fundamental demand was real, tangible, and growing faster than the market understood. In essence, silver is a bridge between two worlds, the old and the new. It carries the legacy of money, but powers the infrastructure of the future. It is simultaneously emotional and practical, finite and functional. When Buffett made his move, he was recognizing that this bridge was undervalued, that the market was still treating silver like a relic of the past, while the future was quietly building dependence on it. That's not just investing, that's perception arbitrage, seeing reality a few years before the crowd does. So the silver bet wasn't about chasing a shiny object. It was about identifying a metal whose intrinsic worth was expanding while its price remained compressed. That's the kind of imbalance great investors look for, not in headlines, but in the undercurrents of data, behavior, and time. Silver's dual identity made it not just a hedge, but a thesis, one that connected the human instinct for security with the technological hunger for progress. And that in itself is a bet on the entire arc of civilization. The real story of silver isn't just about its beauty or its history. It's about what's happening beneath the surface, the tightening of supply, the slow erosion of inventories, and the structural imbalance forming between how much the world needs and how much it can produce. When Warren Buffett made his big silver purchase, he wasn't just betting on sentiment. He was reading the underlying economics of scarcity, and scarcity, when combined with growing utility, is a force that reshapes markets in ways most people only recognize in hindsight. For decades, silver production has been trapped in a paradox. Roughly 70% of the world's silver supply doesn't come from dedicated silver mines. It comes as a byproduct of mining for other metals, lead, zinc, copper, and gold. That means the silver supply is largely at the mercy of the economics of those other metals. If copper prices fall and miners scale back production, less silver comes out of the ground. Regardless of how strong silver demand might be, it's a fragile system that doesn't adjust easily. This makes silver fundamentally different from something like oil, where production can ramp up or down based on price signals. With silver, the supply response is sluggish, constrained by mining complexity and capital cycles that move at a glacial pace. Buffett saw that structural constraint. He recognized that silver wasn't just undervalued, it was underproduced. At the time of his accumulation in the late 1990s, global inventories were being drawn down year after year. Industrial demand, driven by electronics, photography, and emerging technologies, was consuming more silver than the world was producing. Governments that once held strategic reserves had been selling their stockpiles for decades, gradually draining a buffer that had kept prices stable. By the time Buffett entered the market, the safety margin was almost gone. The world was living on borrowed inventory. That's the kind of setup that doesn't just invite a price rally, it invites a structural revaluation. Markets often ignore slow-moving imbalances because they build quietly. It's like erosion, unnoticeable day to day, but transformative over time. When the data finally catches up, prices tend to move violently, not because fundamentals suddenly changed, but because perception did. Buffett positioned himself before that perception shift. He didn't need a crisis, he just needed reality to catch up with math. In the years since, those same pressures have only intensified. Mine output has stagnated, and many of the richest deposits have been depleted. Meanwhile, new industrial uses, solar photovoltaics, electric vehicles, 5G technology, have dramatically increased consumption. The Silver Institute's data shows that in several recent years, the market has run a physical deficit, with demand exceeding supply by tens of millions of ounces. Yet prices remain relatively muted compared to the magnitude of that imbalance. That's what happens when a market is thin, financialized, and misunderstood. Investors focus on short-term sentiment, ignoring the slow squeeze underneath. This is where the psychology of supply comes into play. Scarcity doesn't just move prices, it changes behavior. When inventories tighten, users begin to hoard, producers start to hedge, and speculators smell opportunity. Each of those actions reduces available supply further, amplifying volatility. It's a feedback loop, and once it starts, it tends to overshoot. Buffett's silver bet, in that sense, wasn't just a trade. It was an anticipation of a coming feedback loop. He understood that when supply is constrained and demand is sticky, prices don't rise smoothly. They jump in steps, often shocking the unprepared. This idea that shortages can hide in plain sight is central to how disciplined investors think. Most people look for catalysts, a headline, a rate cut, a war. But real catalysts often start invisibly, in inventories and balance sheets. Silver's deficits were a quiet catalyst, the kind that builds tension without fanfare. Buffett simply had the patience to see it through. He knew that when inventories fall below critical thresholds, markets don't adjust rationally, they panic. And panic, when you're positioned early, is profitable. The broader lesson here extends beyond silver. Every market has its invisible corner, the part where supply is rigid and demand is underestimated. Silver just happens to embody that principle perfectly. It's a case study in how inefficiencies form in plain sight, how consensus can stay blind for years, and how true value investors capitalize by listening to what the numbers whisper instead of what the headlines shout. So, when Buffett built that mountain of silver, he wasn't predicting the future in a mystical way. He was simply acknowledging a simple truth: you can't consume what isn't produced, and eventually price has to reconcile that reality. The world's relationship with silver has always been cyclical, waves of abundance followed by droughts of supply. But this time, the drought has been deepened by industrial progress and decades of underinvestment. Buffett's move was to own scarcity before the crowd realized it existed. That's the hidden genius of his bet. It wasn't about trying to outgas the market. It was about trusting arithmetic over emotion, structure over speculation, because in the long arc of markets, supply deficits are not stories. They're equations, and equations eventually demand balance. When a man like Warren Buffett steps into a market he once dismissed, the world takes notice, not because of the capital he moves, but because of what that move signals. Silver was never part of his usual playbook. For decades, he championed productive assets, businesses, cash flow, compounding. He had called gold an unproductive metal that just sits there looking at you. So when he quietly accumulated over 100 million ounces of silver, it wasn't just a trade, it was a psychological earthquake. It challenged the collective assumptions of investors everywhere. When a disciplined, rational thinker alters his stance, it forces everyone else to question their frameworks. That's how market psychology shifts, not through noise, but through credible contradiction. In investing, perception often matters as much as fundamentals. Markets are not engines of logic, they are machines of belief. When someone like Buffett, who had spent his career warning against speculation, enters a space known for speculation, the crowd begins to recalibrate. What does he see that we don't? They ask, and that single question can ignite a wave of rethinking across the system. Suddenly, analysts start revisiting old data. Traders start adjusting positions. Asset allocators begin to consider exposure they once ignored. A single decision backed by credibility can ripple through market psychology like a stone through still water. That's what happened with silver. Buffett's move validated an asset class that had been dismissed by institutional investors for years. It wasn't a retail frenzy, it was a subtle reawakening of interest from the top down. The irony, of course, is that Buffett didn't intend to make a statement. He was simply acting on logic. But in markets, logic from a legend becomes prophecy for the crowd. People project meaning onto it, sometimes more than it deserves. That's the paradox of influence. When your reputation is built on patience and prudence, even a small deviation is interpreted as revelation. What's fascinating about this episode is how it demonstrates the reflexivity George Soros often talked about. The idea that markets don't just reflect reality, they create it. Buffett's purchase didn't just respond to fundamentals, it altered them. His presence brought legitimacy, which attracted attention, which influenced price, which in turn confirmed the narrative. It's a feedback loop of psychology reinforcing economics. Once investors believe silver is valuable again, their actions make it so, at least for a time. And Buffett understood this. He knew that in thin markets, perception moves faster than supply. His quiet accumulation, once public, would trigger a psychological repricing that would help fulfill his own thesis. That's not manipulation, that's mastery of timing. Crowded trades are another psychological phenomenon worth noting here. Most investors don't realize they're in one until it's too late. By the time an idea feels comfortable, it's usually overvalued. Buffett has always operated on the opposite principle. He buys when an idea feels uncomfortable, when the crowd has abandoned it. His silver bet was the embodiment of that discipline. Silver in the 1990s was an unloved market. The smart money was elsewhere, chasing internet stocks and growth narratives. Nobody wanted to talk about a dull metal stuck under $5 an ounce. That's exactly why he could build such a large position without resistance. In behavioral finance, there's a concept called availability bias, the tendency for people to overvalue information that's recent or popular and undervalue what's quiet or forgotten. Silver was forgotten. It wasn't available in people's mental models. Buffett exploited that blindness. When news finally broke that Berkshire Hathaway was the mystery buyer, it triggered a rush of attention. Prices jumped, media coverage exploded, and suddenly everyone wanted exposure to the metal they'd ignored for years. It's a perfect example of how narrative lags reality. The market always catches up, but late and emotionally. This is why signaling matters so much in investing. When a respected figure acts contrary to his usual habits, it's more than an investment, it's an education in contrarian reasoning. Buffett didn't preach the value of silver, he demonstrated it. And in doing so, he reminded the world that intelligence in markets isn't about having the loudest voice or the flashiest forecast. It's about the willingness to stand apart long enough for fundamentals to prove you right. The deeper insight here is that great investors don't just analyze numbers, they analyze behavior. They know that markets are driven by cycles of optimism and fear, greed and neglect. By buying when nobody cared, Buffett was effectively buying a psychological discount as much as a financial one. When everyone believes something is irrelevant, its price tends to reflect that indifference. When belief returns, even partially, prices re-rate dramatically. Buffett's silver position, therefore, became a case study in how conviction can alter collective perception. It showed that leadership in markets isn't about talking others into your view. It's about quietly taking the other side when the crowd has stopped thinking. That's why his move felt so powerful. It wasn't loud. It wasn't public, but it was undeniably meaningful. In the end, the real value of that signal wasn't just the return on silver. It was the lesson that conviction, when backed by analysis and patience, can bend the psychological gravity of the market itself. Investors chase narratives, but disciplined thinkers create them. Buffett didn't just bet on silver, he bet on the idea that the world, sooner or later, would remember why it mattered. And once he placed that bet, the market, as it always does, began to follow the signal.